So let's continue. Our currency of the week is dollar CAD. For many of you, it's been a bit in the background, but I want to talk about that because of the crash in oil prices. So first of all, let's explain the crash. It was triggered by the inventory report 1 week ago that showed a rise in inventories, but it showed a rise in crude inventories and it showed a drop in gasoline and distillates. So for me, it was only the match that started the fire. The bigger background is the OPEC deal, okay? So back in November, OPEC and non-OPEC members surprised the world by reaching a deal on cutting production. So if we focus on OPEC, they're 90% compliant. 90% sounds great, and in the past they had a much lower compliance rate with cuts, okay? On the other hand, it's mostly Saudi Arabia that cut production, and they cut production even more than they were expected. Other countries are actually not that compliant. Moving to non-OPEC countries, it's Russia, mostly Russia, okay? And they're going very slowly. They have not met their obligations, and for all non-OPEC countries, it's about 60% compliance, okay? And there's uncertainty about the deal extension. Remember, this deal is only for 6 months. It's only for the first half of 2017. There's another OPEC meeting in June. And all we're hearing so far is that they're not sure if they're going to extend the deal. And of course, it was always the big elephant in the room, or not elephant, US shale production. So when prices rise, US production rises. When prices fall, US production falls. So as prices were holding high ground for some time, production from the US increased. So we crossed the 9 million barrels per day level, and production is on the rise. And the inventories only provided the spark. So here's the WTI crude oil chart. As you can see, from early December until early March, prices were high, but we saw a rejection there, double top of 55.20, and then we crashed lower, and currently we're in a much lower range. So, but Canada also looks good. Here's Prime Minister Justin Trudeau meeting President Trump in one of the more successful meetings that Trump had, and I think it was successful also for Canada. So there's no risk from NAFTA changes, no risk. Well, the US is more focused on making a better deal with Mexico, but not so with Canada. There were 3 consecutive wins for jobs reports, okay? So 3 huge surprises. The unemployment rate fell in Canada to 6.6%. Job gains are looking good. More in particular, job gains were concentrated in full-time jobs, not part-time jobs. And Canada, of course, is not only about oil. But at least in the short term, oil prices are still set to weigh. The Bank of Canada was recently a bit dovish, a bit sort of, I would say, more cautious than dovish. And eventually, a weak Canadian dollar helps the economy. So we have a weak Canadian dollar. It helps the Canadian economy. And then the Canadian dollar rises. The Canadian dollar rises. It weighs in the Canadian economy. And we're in this pendulum swing. Okay. So what's next for the Canadian dollar? I would say that in the short term, falling oil prices, I'm not sure we've seen the end of the falls. They could have the upper hand, but I wouldn't say it would last that long. So it could be a short-term rise in dollar CAD, and then we could move higher. So let's take a look at the Canadian dollar to conclude this segment. Currently 134.50. Let's zoom out. We can see that we're at the higher end of the wider range, okay? So, and to the top side, we have 135.40, 136, and 136.35. 136.40. If we move even higher, the next significant lines of resistance are only at around 140. To the downside, we have 133.80, 133, 131.80, and 130 as a line of support, much lower support at 127.70. Okay,